Would you say the Fed is actually accommodative, restrictive, relatively neutral?
I think they're accommodative. You look at bond spreads in the real economy and how risky borrowers can access capital and do all kinds of things.
You're listening to IBKR Podcasts. Find more conversations at ibkrpodcasts.com. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show.
Hi, everybody. Welcome to the latest edition of IBKR Podcasts. Today, I'm your host, Steve Sosnick, Chief Strategist at Interactive Brokers. I'm joined by my colleague, Jose Torres, Senior Economist here at Interactive Brokers. Hi, Jose.
Hi, Steve. Hello, everyone.
Today, as is customary, we're doing our monthly economic roundup. We typically do those on the Monday after jobs numbers. And last week, we had an extra special week because we also had an FOMC meeting that coincided with those job numbers. Just as a parenthetical, I find those weeks very interesting because a similar week in February of 2023 was what I like to call the debutante ball for zero-dated options. And the reason for that was you had a similar setup with a Fed meeting on Wednesday and jobs numbers on Friday. That was, I believe, the first time that the markets went crazy with the use of disinflation. I think that was the buzzword that week. And people discovered on Thursday, wait a minute, we can speculate to our heart's content and not have to hold options that leave us exposed to the jobs numbers on Friday, which at that point actually were a bit of a disappointment and took away probably a third to a half of the two-day gain. Sorry for that long-winded intro, but Jose, as you look at the numbers as an economist, both holistically for the Fed meeting and for the jobs numbers, which seemed complementary, what's your takeaway?
Total jobs added were 175,000, which is typically strong. However, in the months preceding that, we've had job growth a lot stronger. From that 175,000, 95,000 were added from one sector, which was private education and healthcare. Wage pressures softened significantly down to 20 bips month over month. Unemployment rate ticked up. Collectively, market participants were very happy because the report as a whole showed that labor conditions are softening. Most employers aren't hiring at a really fast clip, but they're also not firing. Initial unemployment claims, continuing claims are well behaved. Job openings still well above pre-pandemic levels, above 8 million. Corporates are in a wait and see mode. Last few years, we've had a lot of stop and go kind of economic conditions where we're thinking the consumer falls off a cliff, then they come and they pick up their spending right away, and then we're back into an expansion mode. Overall, though, alongside the first quarter GDP, this payroll print, especially its concentration in that non-cyclical area of private education and healthcare, is pointing to slower conditions.
That kind of leads me into the next phase of it because Powell gave yet another what I would call a Goldilocks press conference where he really pushed back on the idea of rate hikes, which I think was kind of freaking people out a little bit. But he also pushed back on the idea of stagflation. And 10 o'clock on Friday after Eastern time, we received ISM numbers that sort of had another whiff of stagflation. Could it be that his dismissiveness of stagflation is maybe because his definition is a bit more real, nasty 70s stagflation orientation rather than just sort of the malaise that we might get with mildly higher prices and mildly stagnating or just a generally blah economy?
I think that's a discrepancy there. Folks remember stagflation. They want to see, when they're thinking about stagflation, negative economic growth and higher inflation than target. But the difference here is that we're seeing that in direction, right? We're seeing inflation jump from fourth quarter of last year, and we're seeing economic growth slide. So in direction, we're headed towards stagflation, but in magnitude, we're not there yet. And I think that's the difference. Economic growth is still positive. Consumers are still spending, albeit savings rates are near the basement. Confidence and sentiment levels have been waning recently, particularly the Conference Board's figure. So overall, there's risks of stagflation, but I don't think it's right around the corner because the consumer's propensity to save is particularly low, and that's really going to drive revenue growth and GDP numbers higher overall.
The second part would be, did he move the goalposts a little bit when he reminded everybody that we've been focused on one half of the Fed's dual mandate, the prices portion, while sort of ignoring the full employment portion, because quite frankly, we hit the full employment portion. Is he sort of premature in refocusing the dual part of the dual mandate, or is that an appropriate move at this point based on what you saw in some of the job numbers?
When you consider the jobs number, then maybe he's more justified. But he did say during the conference that they don't have access to the numbers before we do, right? So we can't we can't assume that he knew a soft number was coming, right? But let's rewind a little bit prior to the report. We've got inflation data for January, February, March, and April incoming. 4 months so far this year. Not one of those reports, including the one that we haven't seen yet, is going to show inflation that's running at the Fed's 2% target on an annualized basis. This goalpost is particularly low because all I'm saying is get me to 17 bips month over month on CPI core, CPI headline, PCE headline, PCI core, whatever you want. We haven't gotten there in January, February, March, or April.
Which also means that as you annualize, there are people who annualize, just sort of take the number, multiply by 12. I believe a lot of economists, I believe including yourself, prefer to annualize the rolling last 3 months. But as you say, if none of those numbers annualize to 2%, where are we? What is your favorite annualization? Because I don't want to put words in your mouth.
I like 3 month annualized, but I do like CPI, Steve. And I like CPI more because it really adequately reflects the housing element of Americans' budget constraints. PCE weighs housing at around 20%. CPI weighs housing a lot higher. And that's actually part of the reason why CPI has been quite loftier than PCE.
Okay, that's a very important distinction. And while we're throwing out acronyms here, one of the important things that I took away from the FOMC statement was that the Fed will be reducing quantitative tightening. So they will be, instead of letting the balance sheet run down by 60 billion each month in treasuries, that number will only be 25 billion, meaning they're going to reinvest 35 billion in proceeds from maturing treasuries more than they had been. Two things came up because I happen to be at an options conference at this point. And so various people affiliated with the industry were buzzing about this. And two things came up. One person said, well, isn't that QE? I pushed back on her a bit, saying that just because you're tightening at a slower pace doesn't mean you're easing. I'd like your opinion on that, but hold that one sec. And the second, which I thought was a more difficult question to wrestle with, and I really want your opinion on this, is this a way that the Fed can exercise some sort of yield curve control? So if you could take those up, I'd really appreciate that, Jose.
Absolutely. By lowering the runoff rate, you're essentially helping out the Treasury, right? And that is essentially yield curve control, not putting as much pressure on the long end of the curve. This is something that you mentioned a lot in your commentaries, and something that sort of disturbs me because the Fed is just so adamant about all this patience they have and over time. And as long as we get there, and the SEP dots show that they're going to get to 2% in 2026. And in 2021, Steve, when they were adding securities to the balance sheet, we already were getting inflation readings that were super strong. Capital markets were buoyant. It was clear that we didn't need any further monetary stimulus to that degree, which at the time was 120 billion. And they just kept going and going all the way, if I'm not mistaken, to March of 2022. And now we're in a rush to totally cut more than half of the runoff on the Treasury side because we're getting concerned over bank reserves and reverse repo and liquidity conditions. And we're favoring financial stability and employment. And we're implicitly accepting inflation at 3 to 3.5%. And that's what I think is going on. Overall, final point here, gone are the days where monetary policy restrictiveness is based upon one number. Oh, the Fed funds rate is 5.5% in the upper range. Oh, that's 2 percentage points above CPI at 3.5. Wow, that's restrictive. When you consider everything else you're doing, whether it's the dovish rhetoric from the Fed, the speed at which the central bank comes in to help when volatility emerges, the balance sheet situation, all those things collectively point to quite a loose monetary policy regime. And when you look at financial conditions indices, whether it's the Bloomberg, the Chicago Fed, Goldman Sachs, all are pointing to looser conditions that really don't point to slower inflation readings in the next year or two. Finally, geopolitics have been improving in the last few weeks. If that continues that way and tensions are kept at bay, that is going to help the Fed with the price pressure objective, albeit I don't think they're going to get to 2%, not with this kind of loosening in financial conditions.
That to me really is the key here. And I think it's very important for people to keep in mind that, number one, I think your point is crucial. Although the Fed is restrictive, I'm going to call it restrictive-ish for the reasons you just described. And number two, historically, the Fed's been forced to look as far back as like the 70s, which most investors who are currently active just don't have a history with. If you would have been active in the late 70s, you're probably of retirement age, whether or not you're still investing or not. So whole generations have grown up not realizing that historically, but even so, like into the 90s and early 2000s, that a 5% nominal interest rate and a 2%, give or take, real interest rate is normal historically. The problem is, I think for 15 years, we've gotten conditioned to the idea that these numbers need to be somewhere near zero. And they don't necessarily. And I think this is where your point is critical, is that you can be sort of, if not accommodative, only mildly restrictive, or certainly not restrictive to a point where you really are punitive with numbers around here. So just final lightning round question. Would you say the Fed is actually accommodative, restrictive, relatively neutral?
I think they're accommodative. You look at bond spreads in the real economy and how risky borrowers can access capital and do all kinds of things. When you consider how strong real estate prices have been, how strong equity prices have been. Finally, we used to have rates like this back in the 70s. The push and pull there, Steve, is the valuations, right? Back then, homes weren't worth as much as they are now in proportionate to average incomes, right? That relationship is totally out of whack. We've learned effectively to live with stock market valuations that in the past would get people scared. We've learned to live with them. And I think those are the crucial developments of today.
Jose, I found this a very enlightening discussion. I certainly hope our listeners have. We're going to wrap it up here. To everyone, thank you for listening. You've been listening to IBKR Podcasts. You can find all our recordings at IBKRpodcasts.com, or certainly you can find the commentaries that Jose and I write, along with several others, from outside sources at IBKRcampus.com. Take care, everybody.
Thanks for listening to IBKR Podcasts. As always, we have more episodes at IBKRpodcasts.com. And if you're interested in learning more about interactive brokers, visit IBKR.com. We offer more trading education material, such as webinars at IBKRwebinars.com, financial and economic commentary at tradersinsight.news, market-related courses at tradersacademy.online, and quant-related articles at IBKRquant.com.
The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. This material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, as necessary, seek professional advice.
Options involve risk and are not suitable for all investors. For more information, read the characteristics and risks of standardized options, or ODD, which may be accessed through the link found in the show's notes or podcast description page.